Good afternoon, everyone. I see Nikhil Bar, moderator of this webinar. Welcome you all in this webinar being organized by the International Taxation Committee of ICI. It is my pleasure to be a moderator for today's webinar. The topic permanent establishment when business presents triggered tax. This is very important topic, especially for the foreign enterprises. Mr. Gaurav Singhal will have deeply explained about it. Before we begin, I would like to give a brief introduction of Sri Satish Kumar Gupta, Chairman of International Taxation Committee of ICI. Satish Kumar Gupta sir is currently serving as chairman of the International Taxation Committee of Institute of Chartered Accountants of India. In addition, he holds the position of chairman of aggregation of CFN committee and serve as a vice chairman of the Board of Studies Academic of current term. Now, I request to Satish sir for welcome us.
Thank you, Nikhil. Thanks a lot. I should start with addressing CA Gaurav Singhal ji, the speaker of the day, a very renowned professional working in corporate and international tax and has contributed a lot for the profession. My brother Nikhil, who is moderating this session, CA Rohit from the committee, who is leading the committee, and from the front as a secretary of the committee, Kapil Gupta ji, team International Tax Committee and team TAC for organizing this webinar, and my dear friends who are attending this webinar, I think third of the this year on a very important topic, permanent establishment from the entire country. So welcome to each one of you and good afternoon, everyone. Friends, it is really a pleasure to welcome each one of you again. And what was the purpose to hold these webinars? I would just want to explain, my dear friend, that international tax is very important subject. But our members are not showing their interest in this subject as they show in other topics like direct tax, like indirect tax, GST, etc. I was of the view that through these webinars, we should create an interest of our members in the topics of the international tax so they can avail this opportunity for their professional career. I can understand that it will take time, but I believe that by the year end of this council year I'm talking about, we will be in position to add several other members in the field of international taxation practice. So friends, we all are aware that now there are no boundaries. You can work sitting in your office in India, throughout the country. And there are several free trade agreements are happening with the government of India. We have made very, very big FTAs. So I can visualize that there is a very big scope of international taxation. And if we talk about the international tax, so we should understand the permanent establishment also. We all know that if one person residing abroad, I'm talking about India context, and he does some business in India, his income is generally taxable in his country only. But this provision of permanent establishment may have a tax effect on that person in India also. So that is a very crucial thing. If our members are not aware or they do not convince their clients about this provision of the permanent establishment, then there may be some very big tax effect on their clients. So I think we all must understand what permanent establishment is and how what are the situations when there can be a tax effect on those type of persons who are not in India, but their permanent establishment is maybe in India. So there are three, four types of permanent establishment, which I think our learned speaker will deliberate in detail. But just to brief that it may be fixed place permanent establishment, it may be agency permanent establishment, it may be service permanent establishment, and it may be construction permanent establishment. But now the concept of the digital establishment also in picture. So I think Gaurav sir will also explain that how it can affect the taxation things in India. And I would like to request Gaurav sir that kindly also deliberate the things in the light of the very famous decision of Morgan Stanley and recent decision of the Netflix and one decision of that Formula One there where the 3 days event was there and that was taxed in India even after a very big litigation. So how can the members take benefit of all these things? And I know that you will also touch the poem that in this, although you know better than me that whether poem is part of permanent establishment or not, but if we can connect the things, that will be beneficial for the members at large. So friends, but now after this brief introduction of the topic of the day, I would also like to tell you about the committee, that what we are going to bring new things in this committee. We are working that we already have a diploma course on UAE corporate tax, which is very demanding, and several members have accepted this as an opportunity. We already have a post-diploma qualification course on international taxation, and that is also welcomed by our members. And this is a very popular post-qualification course of ICI. We already have a certificate course on income tax in US. That is also a very good course, and I think we have started it last year, and several members have taken benefit of this particular course. But apart from these three certificate or post qualification courses, we are also trying to bring three more certificate courses covering the UK, Singapore, and South Africa. So providing a very good opportunity to our members if they are interested to practice in those countries in tax domain, they can understand what are the provisions in that particular country and how can they have an opportunity to do practice at that country. Apart from this, friends, we are in discussion with several tax experts, and in our seminars in India, whatever we will organize in national tech seminar on or the conferences, we want to have the the topics of tax system of several countries. May it be Malaysia, may it be that Saudi Arabia. So whatever there is a link in between India and that particular country, there are chances of further developments, and there is a possibility of opportunity for our chartered accountant members in that particular country. We are trying to bring a basic knowledge seminar of all those tax systems of those countries in our conferences. So this is our planning this year. Beside this, we are holding a weekly webinar on every Wednesday on different type of topics on international taxation. So ensure that you attend all webinars which we organize on every Wednesday. So keep yourself free at 4 to 6 and try to attend this particular thing. We are also coming up with a mobile app along with the DTC Direct Tax Committee, where by using that mobile, that is a very user friendly mobile app we are going to going to bring, and you can use for several things of direct tax and indirect tax. So I we hope that we would be in position to launch around 1st of July. that particular mobile app of this committee along with the DTC. What I request to my dear friends, if you are interested in becoming faculty of international taxation, or you are interested to be a resource person of rewrite our publications, so kindly show your interest to the International Tax Committee at the citax@ici.in, and our committee officers will definitely touch with you and would invite you to speak or would invite you to take your services professionally. So don't hold this particular interest. If you have, don't resist and show your interest immediately so we can take care of that particular your interest. One more thing, my dear friends, that if you want to hold a seminar or conference at your place and you have the branch there, to kindly tell your branch leadership to hold that and send their interest to the committee. We will take care that that particular conference or seminar or meeting be held at your place, giving you more insights about the international taxation. So with this, I don't want to come in between you and Gaurav Singhal who has come to this place by sparing a very big time for all of us. So I thank him again, sir, that your presence will definitely have a value addition for our participants, and your presence will definitely, we can never forget the time you have spent for our institute for our participants. So thank you very much again, sir. Thank you, Nikhil, for the time and efforts. Thank you, the team, International Tax Committee, and thank you, Team Technical, and thank you, my dear friends, who have attended this particular webinar in a very large number. So over to Nikhil for the next steps of the this particular webinar. Nikhil.
Thank you, sir. Thank you. Thank you, sir, for your insightful, wonderful address and provide such important information to our members. Now, I would like to brief introduction of our today's speaker, Gaurav Singhal, sir. Gaurav, sir, has experience of 19 plus years, specialized in corporate and international taxation. He's regular speaker in various seminars organized by the various firms. He's frequently invited speaker of domestic and international taxation. Now, over to Gaurav, sir.
Thank you so much, Nikhil. Thanks a lot. Thanks a lot to Satish sir also. He has very kindly graced this platform, and we are extremely grateful for his leadership, for the kind words that he has shared, for the encouraging words that he has shared with the rest of the community. I fully support the point of view that as a community, as a professional community, this is the right time for us to rise to the occasion and start taking international tax as a core part of our tax services rather than something which is a super specialized part. The brief that was given to me, and I'm extremely happy that the idea of this webinar is to serve as a foundation for all those people who want to get into this area and they just want a starting point. Today is the first day of the financial year, and instead of the assessment year, I would say it's the first day of the tax year because now we are in the Income Tax Act 2025 regime, which has forgotten the difference between the previous year and the assessment year, and it's all one tax year. So, on the first day of the first tax year, I strongly recommend to all of you, gentlemen, ladies, young and old professionals, that think of international taxation as something which is now core, which is integrated into your core practice or tax practice rather than something which is confined only to some very limited set of professionals. The program which Satish sir particularly pointed out, at our office we are subscribed to at least two of them that I'm aware of. Third one is something that again we are the speakers there. I and my other partners, which is the UAE corporate tax, because we have another office in Dubai. But at least two other programs are the ones where we are subscribed to, and I can vouch for it that the quality that the ICAI is offering is top notch. I'm talking about
Sir,
from our
just
experience.
intervening, sir.
Yes, sir.
We, our committee is holding 2 online certificate courses recently, so just to inform the members. Online certificate course on UAE corporate tax, we are going to hold from 7th of April this month, 7th of April. So if you want, you are interested to, you can register it online. Second online post-qualification course on the international taxation diploma course. It is also starting from 27th of April. So if any member is interested, they can join. Over to Gaurav, sir.
Thank you so much, sir. Thank you. That is useful information. Thanks a lot. So with this, I will now do a screen share and take you through the agenda for today. Now, the agenda for today, I hope this is visible. Nikhil, can you please confirm, sir? If this is
Yes,
Visible,
sir.
sir. Visible, visible.
Got it. Got it. So the agenda for today is that we are going to talk about a crime thriller in which a permanent establishment is a boogeyman. So we'll talk about why it is a boogeyman. Why do we even tax a permanent establishment? And our crime thriller will have 2 seasons. Season one, basics. I'm aware that a lot of people out here are already aware of the concept of permanent establishment. They're probably experts at it. So this will be only a quick recap, right? Our core focus will be on season two, where we will focus upon all those, all those alibis which multinational groups have created to avoid creating a permanent establishment. And the OECD's project on base erosion and profit shifting has focused predominantly upon those alibis and how to address them. So there we have the secret weapon of BEPS, the secret weapon called multilateral instrument. So this is what we will have as our agenda on the first day of your first tax year. First of all, why is PE a boogeyman? Basically, why is it that when we are talking to our clients that are foreign companies, whether we are located in India or in UAE, very commonly we have seen that as consultants, we tell them that, look, what you're doing, this is probably going to create a good deal of mess. And what's the worst thing that we can say when we say that it will create a mess? We say, sir, it's possible that you will end up creating a PE, a permanent establishment here. Here means, in this case, I'm talking about India, right? Not UAE. Why is PE a boogeyman? Why is it the villain? Is it a crime to have a PE? Absolutely not. So while I have structured this only for the sake of grabbing your attention as a crime thriller, it will be wrong to say that to be or to constitute a permanent establishment, it's a crime. No, it's just a threshold for taxation. And yet, the two questions that arise is, A, why is it that we tax a permanent establishment, a foreign enterprise, which is a non-resident? Why are we taxing in India a non-resident just because it has a permanent establishment? And B, fine, it's just tax. But then why is it that when we tax a royalty transaction or a FTS transaction or an interest transaction, that's not so scary. But the moment we talk about creation of a permanent establishment, suddenly the whole table gets flipped and suddenly everybody's temper is going through the roof. Well, let's answer each of these questions one by one. Firstly, why is it that PE is such a scary phenomenon? There are fundamentally, I think, 3 reasons. Reason number one, unlike royalties, FTS, and interests and dividends, which are generally taxed at a discounted tax rate, if that's the word I would like to use, something like 20% under the domestic tax law, and in a lot of treaties, you have a lower rate, sometimes 10%, right? In a few treaties, the rate goes as low as 7.5%. Yeah. A permanent establishment in the context of, say, if a foreign company gets taxed at the rate of 35%. Now, I know you're going to say that, hey, Gaurav, this is not a fair comparison because a royalty and an FTS is taxed on gross basis, whereas a permanent establishment is taxed on a net basis, right? Yeah, but if you ask me, frankly, that's the second reason why PE status is so feared. Why? Think about it. A foreign enterprise will have to prove to an Indian tax authority that the expenses it is claiming as deduction are legit business expenses. It'll have to prove, it'll have to furnish, if required, the copies of those invoices. It'll have to prove that they meet the business purpose test. And then it'll also have to prove that those expenses are attributable to the Indian permanent establishment, and that's the reason why the PE gets a tax write-off. I repeat, permanent establishment is a subset of a foreign enterprise. A foreign enterprise has a lot of income and a lot of expenses. Some of those incomes are attributable to the PE, they get taxed in India. And similarly, in order to calculate that income, some of the expenses should also be attributable to the Indian permanent establishment. That's when you'll arrive at the net total income, which is attributable to the PE in India. So the question is, yes, some expenses are legit business expenses for the foreign enterprise, but are they incurred for the purpose of the business of the PE in India? Now, that is something which requires a completely different kind of an effort demonstrate to an Indian tax authority. Takes a lot of effort, takes a lot of energy, a lot of convincing power, and even after that, often we have found that taxpayers fail. But even if they succeed at it, the third and the last point is when a PE gets created of a foreign enterprise in India, the part of the income which is attributable to that PE is taxable in India, right? That exercise is called attribution. Now, what is that part of the income which is attributable to India? That is also fairly subjective. I mean that I wish there was a very strict mathematical formula that could give an answer to this question. And yes, there are discussions that there will be safe harbor provisions around that also. But so far, the reality is that a lot of litigation around permanent establishment is not just about whether or not a permanent establishment exists, but also about fine, if there's a PE, what part of the profits of the foreign enterprise are taxable in India because they're attributable to this Indian permanent establishment. And because that is such a subjective exercise, we have often seen is that at the initial stages, that means at the assessment proceedings, often tax authorities peg a very high percentage, sometimes as high as 50%, right? To the 50% being the profits which are attributable to the P, because even in their experience, they have found that the taxpayers are able to seek some relief at the ITAT or the High Court level, which is the reason why the starting point itself is pegged at a fairly high percentage. That is the third reason why a lot of foreign enterprises find it a bit of a headache to have a PE in a high tax jurisdiction or a mid-level tax jurisdiction, such as India. They're actually rather happier paying a modest rate of tax at a gross basis, such as a royalty or FTS, because at least that gives them a very high degree of certainty. That again brings us to another question, which I picked up earlier. Why do we even tax a permanent establishment? First of all, let's understand what's the nature of this taxation. The way I think of it is, taxation is basically a service fees that all of us pay for the services that we get. What are those services? When a country offers you its infrastructure and all the other ancillary activities, thanks to which you're able to make all that money that you're making, then it is only fair that you also contribute towards the building up of that infrastructure, the roads, the telecom, the wirelesses, the internets, all of those things are the ones for which we are paying by way of tax, right? So tax is like a service charge. And you know, the first 18, 20 years like is a free trial period for all of you. Because we live here, we utilize these infrastructural assistance most. That is the reason why, as residents, our global incomes are subject to tax in India. Because basically, every penny of income that we are earning thanks to the infrastructure that we have around us. Now, a non-resident is not really earning any part of its income because of the infrastructure which the Indian government offers, right? More often than not, that's the case because, well, arguably their government is the one which will take the same position vis-a-vis their earnings. But often there arises a scenario where we find that a non-resident enterprise, a foreign corporation, has a degree of presence in India. In this case, India is a source state, the state where the source of its income, some of its income is located, right? And that presence in India is not such a tiny one where the Indian government can keep on ignoring that, fine, they're using a bit of our services, but fine, we're not going to charge it because it's going to be too much of a hassle to figure out how much of their income is thanks to the infrastructure that we are providing. At some stage, the share of their income, and more importantly, the share of their presence in India. It goes beyond a point where we start feeling that now, come on, clearly you are using some part of the resources which are being made available by the nation, by the Indian government, and therefore some part of your taxes, well, you should pay to here, right? That threshold in the context of business income is actually permanent establishment. Let me look at it from a different perspective. Um, the first time this concept actually came up was, and I've read it this in book. I don't remember it because this is in late 1800s, like 1889 or 79, somewhere around that. There was an Austro-Hungarian empire which entered into a kind of a treaty. In fact, the first of its kind, almost the first double taxation model settlement with Prussia, right? And there they had a concept where they had a PE synonym which was used to ensure that there's no double taxation. Before that, also in a lot of countries where there was a state level tax, right? Like we have state level GST. There have been instances, again, I'm talking about Austria, Germany, and the likes, right? Where the same concept was used to figure out where there's a business located in one canton, one province, one state, and it is carrying out some activities in another state, then whether or not that other state should tax it, right? Which is the reason why one of the most leading commentaries on permanent establishment, and I'm talking about the one authored by Mr. Arvind Skar, a lot of decisions referred to in that commentary are actually around this local tax laws, right? But circling back, we have talked about why PE has this status where दूर दूर तक जब कोई फॉरेन कॉर्पोरेशन इंडियन कंसल्टेंट के पास आता है तो इंडियन कंसल्टेंट उसे बताता है दैट चुप हो जा बेटा नहीं तो गब्बर पी बन जाएगा. Now we'll move on. Let's see if you have talked about Article 5. So typically Article 7 is the one which talks about taxation of business profits, right? And predictably, Article 7 says that as such, a foreign enterprise will not be taxed in a source state. It will be taxed only in the resident state. But if that enterprise has a PE in the source state, then that income which is attributable to the PE will be taxable in the source state, right? Let's see, that's a starting point of the entire discussion of permanent establishment. Now, what is a permanent establishment? Classically speaking, and I'm here in season 1 of our crime thriller, and I'm telling you the introduction, and I'm introducing the characters to you. So the first and the most basic form of this character is what is called a fixed place permanent establishment, where basically a foreign enterprise has a fixed place through which some business is carried on by it, wholly or partly, right? That's the definition. That's literally the definition. The word fixed, that is a word because of which we have the word permanent in permanent establishment. Now, permanent does not actually mean till eternity. It means there should be sufficient permanence vis-a-vis the nature of business that you're carrying on, vis-a-vis the nature of business cycle that you have, that a large part of your business cycle is actually being carried out through this place. And now when we're talking about the place, you're talking about a geographical location. Now, we are not even halfway through this definition, the first definition. And as I mentioned, you must have already started thinking that, Karam, you're about geographical location. So if I have a place like online, right, will that online place be considered a place for the purpose of a fixed place PE? And you would be probably surprised to know that this question has been asked in various other forums, in fact, in a few appellate forums as well. So far, the meaning of the word place has remained confined to like a physical place, a geographical location. And quite honestly, you'll find that towards the end of this conversation, we'll be talking about how this fixation with geography, with physical nexus, is what is is resulting in the crumbling of trust on the principles of PE, and we need to come up with some replacement. So we started with digital permanent establishment, and now we are talking about to help with the permanent establishment. Let's talk about some more things like an economic nexus, a significant economic nexus or SEP, and beyond that also, such as pillar 1, where essentially in the BEPS project, BEPS 2.0, some of the companies, the largest in the world, like top 100 companies in the world, they will be subjected to tax in source state irrespective of whether or not they have a PE, purely on the basis of economic nexus, purely on the basis of revenues, purely on the basis of users, and so on and so forth, right? So this is the very fundamental nature, the most basic form where long back, maybe hundreds of years back, when countries were thinking about whether or not to tax a foreign company, they felt that, hey, if a foreign company has like a literal office here, like a branch here, come on, then you have crossed the threshold and we should tax you, right? Which is where the concept of fixed place PE or basic rule PE came in to picture. Imagine a foreign entity having shop here, a branch here. Now, because it has a physical, place which is available to it all throughout the year, or for the major part of its business cycle, and it is carrying on business from that physical location, there's no reason why the income from that branch should not be taxed in the country. Yeah. Of course, the questions around it are, do you own that place? Or can it be within the premises of another company? And is the place just available to you, or is it at your disposal? And frankly, that is where a lot of businesses started creating alibis. They started giving excuses that, look, in our case, these premises are not fixed place PE, which is right, which is why in Article 5.2, what we read just now was Article 5.1, right? In Article 5.2, a list was given that please stop debating. These activities will always result in triggering a fixed place PE, right? Article 5.2 initially was supposed to contain an illustrative or inclusive list of fixed place PE. The reality, all those people, all my young friends who are sort of, entering the international tax practice, here's a caveat for you. A lot of times you'll find that in Article 5.2, there are clauses which deals with PEs which are not necessarily fixed place PE. For example, service PE is often found in Article 5.2, right? I'm not saying always, but wherever, in whichever treaty service PE is there, in at least half of them, it's actually interestingly is in 5.2. Okay, alibi number one. In some cases, the foreign enterprises said that, hey, you are saying permanent, right? I was here for only, come on, just 3 days or just 6 weeks, right? Does that mean I have a PE in India? I'm sure this is a very simple alibi. And all of you super sleuths, impressive detectives, Sherlock Holmes, Hercule Poirot, Byomkesh Bakshi's, have figured out what I'm talking about. Yes, I'm talking about the celebrated decision of Formula One by the Indian Supreme Court, in which these were the facts. Formula One said that, hey, you can hardly call our presence to be a permanent, establishment. When we were present here for barely like 3 days, that's the time for which the cars were running around on the track in the Formula One races. That was in Noida, in UP, right? And the revenue said that no, well, technically it's not 3 days because before the races and after the race also, you guys had an access to the whole track and the places around it, like the stands, etc. And yet Formula One persisted and said, come on, if you add all that up, still it's only 6 weeks. So is that permanent enough? Well, to cut the long story short, at some stage, Supreme Court said that, hey, hold on, hold your horses or hold your cars, right? Um, Given the nature of your business, it's not like you are making the cars, the Formula One cars, run around in circles onto the circuit for 365 days a year. No, yes, you're doing that for as it is some very few days in a year, right? So your business cycle is short. And therefore, for that such a short business cycle, if you spend 6 weeks over here, I think that's good enough to be called permanent, right? Similar decisions exist in the context of taxation of businesses dealing with exhibitions and events, where an event lasts like barely 7 days. And if you are organizing, if you're a foreign corporation organizing that event in India, then for all 7 days, the exhibition went on in India. The basic part, the biggest part of your business cycle was all in India. So what if it was only for 7 days? So what if it was for less than 6 months? It still creates a permanent establishment. Why did I say 6 months? I wanted to flag this out to everybody. A, there's no such rule given in any treaty whatsoever, that you will trigger for a fixed place PE if and only if you cross a 6 months threshold. Not at all. Nowhere in, not in any treaty. In some commentaries, however, it is written that for standard plain vanilla businesses, right, which have a business cycle going all throughout the year. Imagine a trading exercise, right? Like a B2B trading exercise. There, because the business cycle is for, well, all 52 weeks, there probably a 6 months presence when crossed will definitely trigger a permanent establishment. Does that mean less than 6 months will never trigger a permanent establishment? Mind you, that's a very difficult statement to make the way the jurisprudence is evolving now, right? So this is the first part, the first alibi, and I'm sure we have all cracked it. Let's move to the second alibi. In this case, um, your client, a foreign enterprise, it has it has entered into some kind of contract with an Indian bank. And you know what? An Indian public sector bank, not just any bank, the Bank of India itself. Can you imagine that the premises of Bank of India, right? It's not a related party of that foreign enterprise. The premises of Bank of India can be treated as the fixed place permanent establishment of that foreign company. I'm sure you'll say, Gaurav, this time the alibi is pretty strong. I mean, come on, we are not just talking about any Indian company. We are not even having any doubts on related party, clandestine contract, nothing. Everything is above board, right? We are talking about Bank of India. It's a separate entity. It has its own premises. Those premises are the ones where the board which is hanging is of Bank of India. The board is certainly not that of the foreign company. Interestingly, in this decision that I'm referring to, in these facts, it's not the case that the employees of the foreign company were using the premises of Bank of India. Not at all. And yet, in this case, the revenue argue that the premises of Bank of India also create a fixed place PE for this foreign enterprise, right? And in this business cycle, essentially, this is a credit card, player, and it said that look, we have like a box, right? Okay, not literally a box. Imagine something like an almirah, which is stacked, right, with servers, and all that stack, right? Just imagine basically a big almirah, right, which is called an MIP in this example. Uh, that is kept into the premises of Bank of India, and that piece of equipment is the one which is encrypting the raw data, which it receives every time you and I swipe our credit cards, which runs on that technology. And that data is sent outside India for processing, clearing, settlement. And once all that is done, foreign company compiles a net position and sends it to the Bank of India. So Bank of India is basically passing necessary bank entries, right, into the bank accounts of the card holders, banks, and the Washington Bank. In this case, interestingly, the in order to demonstrate that the activities carried on at Bank of India are insignificant, if I recall correctly, this company told the court or the advanced ruling authority, to be more precise, that we are paying a very paltry sum. I think it was $1,500 per month. That's it, right, to the Bank of India for use of its premises. Are you saying that to the Bank of India, right? And we are not talking about a small enterprise, no. The Bank of India, if you are making a payment of 1,500, firstly, it will be arm's length. It's not like Bank of India is going to accept that, okay, fine, I'll accept a lot lesser payment so that it doesn't trigger a PE for an unrelated third party enterprise. No. Yeah. So, first of all, if it's an arm's length $1,500 payment for those user premises, that will still trigger a fixed place PE. You are going to say that we guys, the foreign company, is using the premises of Bank of India for our business, because that's the definition of fixed place, right? Interestingly, the Advanced Ruling Authority said, yes, the premises of Bank of India are being used for the business of this foreign company. This foreign company, just in case you're getting curious that, come on, Gaurav, what's the name of this decision? All those who are jumping out of your seat, you know what's the name of the decision. It's MasterCard's Advanced Ruling Authority, right? But this decision had another very interesting issue. Alibi number three, right? This time, MasterCard said that also the revenue is trying to argue, this is a separate argument from the earlier one, that this piece of equipment, remember I told you that the one which looks almost like an almirah, but there are stacks and stacks of server. That's called MasterCard Interface Processor, right? It's just an equipment, no employees around it, no office around it, nothing. Just that one equipment. That equipment will trigger a fixed place permanent establishment in India for MasterCard. Revenue said, yes, sir. MasterCard said, come on, this equipment is not doing it. Maybe what it is carrying out is what is called a preparatory and auxiliary activity. We'll talk about it. But preparatory and auxiliary activities are the activities of which these small, minuscule activities. They're not supposed to trigger a permanent establishment. So what MasterCard's argument was that this is a very tiny activity. And again, the answer of the court here was, we don't think it's a very tiny activity. And instead, they said the mere presence of MasterCard interface processor triggers a fixed place permanent establishment for MasterCard in India. So basically, I'm trying to give you a few examples of how people have tried arguing, foreign corporations have tried arguing that a fixed place PE is not triggered in their special facts, and they've tried giving their particular alibis. But how courts have in different situations held differently. I'm basically trying to point out to you that just in case you come across any such situation where any of your client or your employer has a situation where it is arguing that we don't have a PE in India because we don't have an office of our own. We don't have any premises of our own. We have not owned them. We have not leased them. Mind you, it is possible that these premises may belong to your group company or may belong to your client or may belong to your vendor, and yet they may trigger a permanent establishment. It is also possible that your client's PE may get triggered because just of a piece of equipment. Remember, in case of MasterCard, this piece of equipment was not even owned by the foreign company. It was owned by its Indian subsidiary. So a piece of equipment which is not even owned by the foreign company can still trigger a PE of that foreign company. These are the kinds of things that you have to be on lookout for when you're advising your clients, the foreign corporations. Let's move on to the next kind of permanent establishment, the next kind of boogeyman. I told you that when the business cycles are long, then probably you will argue that permanence threshold will be met only if I spend a good deal of time. When the business cycle is short, then the revenue will argue that only a few days presence is sufficient to trigger a PE. Now, in the context of contracts such as construction contracts, installation, and I'm not talking about software installation. I'm talking about installation of a power plant, of a steel plant, of a coal plant, right? Huge plants, their installations, or construction of any infrastructure project, any huge building, any DMRC kind of a project, right? There, the business cycles are naturally long, right? In that case, there will always be fights that would 6 months trigger a PE, would 10 months trigger a PE, would 2 months trigger a PE. Now, a great deal of revenue and therefore tax revenue is also locked up in these contracts because these contracts tend to be very, very, very capital intensive. And more often than not, we invite foreign corporations for bids, for tenders, because a lot of times we lack the specialization, the technical knowledge to run these contracts from end to end purely on a captive basis. Therefore, what we find is that a lot of money goes out to foreign builders, and we want to be very sure that money is not locked up in litigation over what is the permanence threshold. Because I told you in fixed place PE, none of the treaties have prescribed the exact number of days, which, if crossed, will trigger a PE. Construction PE is actually the antithesis to the same principle. That is, here also, we are talking about a permanent establishment of a foreign enterprise. But here, the PEs, the treaties specifically, expressly state a number, the number of months or days, which, when crossed at this site, the building site, the construction site, the installation site, by the foreign enterprise, will 100% trigger a permanent establishment. No questions asked, right? So therefore, what you will find is that in building, in construction and installation permanent establishments, typically all the treaties state that a PE will be triggered if the foreign enterprise crosses X number of days on the site. Typically, it is usually 6 months, 180 days, and so on and so forth, right? It may vary from case to case on that. And interestingly, you have to apply this test to each separate site individually. So what I'm trying to say is, if this one project which is running in Delhi and there's another project which is running in Calcutta, both of them are completely independent projects. There's coherence between these projects, right? Then it is possible that your foreign company client has crossed 4 months at one place, 4 months at the other place also adds up to 8 months, right? Not necessarily, because you have to measure it for each of the site separately. Since none of the two sites have crossed 6 months, interestingly, none of the sites trigger a permanent establishment. There are exceptions to this rule, and we'll talk about it because the minute we create a rule, people try to abuse that rule. Yeah. And they come up with interesting alibis. So we'll talk about that. Here in these couple of slides, which I'm leaving for your home reading, I've talked about the concept of coherence. When I told you that Calcutta and Delhi, they will not be treated as same project. Why? Because there's no geographical coherence between the two. But at times when there is a geographical coherence as well as a commercial coherence, projects running in two slightly different locations can still be treated as one single site, can still be counted as one single PE. And that begs the question, when do you start counting the days? When do you end counting the days? And this slide will answer those questions for you. Now, alibi number one, alibi number one, alibi number one. What do these guys who are probably at the risk of creating construction PE, right? What do these guys come up with an alibi as that why do they not have a PE in India? It was observed, and not recently, sometime back in past, that in a lot of these cases, these foreign corporations who have the requisite expertise, they slightly pivoted their business model. They realize that actually the expertise is in the know-how, not really actually executing the construction work, right? You can get the construction work executed from a local company, in our case, an Indian company. But the Indian company will not have the know-how, the intel, the technical knowledge on how to carry out that project, which is the reason why a lot of these construction majors, they pivoted their business model where they said that the foreign company's employee or foreign company's role will be only limited to supervising the activity which is happening in the Indian construction site. The actual act of construction is not carried on by the foreign company. That is carried on by an Indian company, sometimes a group company, sometimes maybe even a third party. Yeah. So with just supervision, trigger a permanent establishment, that alibi was broken down long time back when even the OECD said, look, when we are talking about construction P, we also include supervision. If countries want to be very, very specific about it, they can include it in their treaty expressly. But even if they don't, OECD is very clear about it. Pure supervisory activity also leads to a construction PE. So that was alibi number one. Now, in some cases, the alibi was that we are we are not carrying out the entire activity. We have subcontracted a large part of the activity to an Indian company, or maybe to another, foreign company. So maybe that other foreign company has a PE, but we don't because we have subcontracted it, right? I think, frankly, the principle of agency answers this question. The acts of the agent are acts of the principal, acts of the subcontractor are the acts of the contractor. And that is where the scale rests right now. That just by taking an alibi, taking an excuse that you got a contract, which was, say, for 10 months, but you have subcontracted 8 months worth of contract to another entity. That means you are left with only 2 months contract? Not at all. A subcontractor's scope of work is included in your scope of work. It's just that you are not yourself present, but your subcontractor is. So if your subcontractor is present at the site, that duration for which the subcontractor is present is to be included in your duration to figure out have you or have you not crossed the construction P threshold. And mind you, the subcontractor is also a foreign company, right? Then it may also trigger a PE for itself. In my example, if this contractor is present on the site for 8 months and you are present on the site for 2 more months, then both of you have crossed the P threshold. It has crossed 8 months, you have crossed 8 plus 2, 10 months. Don't think that you can argue that there shouldn't be a double counting. The law is pretty clear on this thing. There won't be a double taxation. Why? Because what you will pay to the contractor will be deductible for you in computing your taxable income. So that amount will be taxed only twice. Having said so, both of you will form a PE in India. Now let's move to the third kind of permanent establishment, right? Remember, we are still on season one. So we are now getting introduced to another, boogeyman. Why was this boogeyman even born? There's a reason why. At some stage, when foreign companies realize that having your own office, like having an office with your own board on it, right? That triggers a fixed place permanent establishment. Plus, it's a bit of a hassle operationally. Leave the taxes, but it's a bit of a hassle to have your own office and to worry about all the various compliances that you have to do for yourself. Why not just simply hire a guy there, like an agent, right? And that agent will conclude contracts for the principal, the foreign company, will secure orders, will probably even deliver goods, right? These are the three activities which trigger an agency PE. But any agent, no, only a dependent agent. If an agent is an independent agent, then even if he's carrying out these activities 24/7, he'll not trigger an agency PE because he's probably doing it for so many others, right? So therefore, he is not your virtual extension. That means your foreign company's virtual extension into India, and that will not therefore create an agency PE. Now, this is the rule. What is dependence? This is decided on the basis of legal and economic dependence, and therefore vice versa independence. The activity of conclusion of contract is not a one-off activity. It should be done habitually. It does not extend to internal contracts. Internal contract, I mean, assume you have taken an Airtel connection, and technically you have entered into a contract. Or for that matter, even if you have hired an employee, you have entered into a contract. But these are internal contracts. They do not trigger a permanent establishment. Which kind of contracts trigger a permanent establishment? Basically, the ones which are relating to sales. That's an easy way of putting it, right? Generally speaking, it is considered that the agent has to enter into the contract into the name of the principal, right? That is own name, that means in the principal's name, right? But we'll talk about this as something which led to a loophole and how it was plugged. So let's talk about these loopholes. Loophole number one, alibi number one. In a lot of cases, we see foreign companies take a position that, yeah, we have a presence in India. Maybe it's even a group company, but it's not going to trigger an agency fee. You know why? Because the group company is not concluding any contracts. It's only providing support services, marketing support services, MSS, right? What do we mean by marketing support services? The argument is that the employees of the Indian company, the Indian group company, right? They're not actually concluding contracts. They're just helping the foreign company in concluding contracts with the Indian customers. How are they helping? Maybe they arrange the meetings wherever they require. Maybe they help with translation. Maybe they help with liaising the flow of documents. But they are definitely not signing the contracts themselves, right? That's something which is done definitely by the foreign company and its employees. They're not even going out and soliciting per se. Yeah, I mean, they get some list of people who may be interested in our services, but it's not that they go all out and they sell aggressively. Yeah. Well, this is an alibi. Now, what we have to look at is what is the real nature of the crime. We have some clues, and we often come across these clues. Clue number one. Often it is seen that this, innocent agent, the marketing support service provider, right? The guy who's not soliciting, who's not negotiating, whatever he sort of, suggests to the Indian customer, prospective customer, and that suggestion, when he passes on to the foreign company, the principal in this case, right? It gets approved in 2 minutes time, like always, right? The minute the agent in India, right? The Indian company's employee, he sends an email telling the foreign company that, look, I met a customer and the customer is interested in buying your goods. This is the price, this is the quantity, these are the terms. See, if you want to talk to the principal, to the prospective customer on your own, I'm just suggesting, I've not done any negotiations, right? The email went out at 12:08 p.m. That is, approval came at 12:09 p.m. IST. What the hell, right? Maybe once, maybe twice. No, every time, routinely, the principal is approving the terms which are suggested by this local agent. That means, really speaking, the entire act of concluding the contract has already happened here. You're just pretending that the principal is the one who's negotiating the contract. In another case, and this is a very celebrated decision in the case of Rolls-Royce. Rolls-Royce was arguing that it is a Lajin office in India, but those guys who are in the Lajin office, they're not really going out and doing any activity of selling. But as a result of a survey operation which was carried out on Rolls-Royce, some minutes of meetings were discovered at their office, and what was found was that the minutes of meeting, it was clearly written that Rolls-Royce guys are actively and heavily, selling to the prospective customer. If I recall correctly, that was the Ministry of Defense in this case, and therefore these clues directly led to the breakage of this alibi that the local agent is not participating in actively in negotiation, but is only a passive participant. What else? Okay, let's quickly touch upon service PE. Yeah, this is the next kind of PE, a new character. Uh, Essentially, this permanent establishment is present in only a very few treaties in comparison to the total number of treaties that we have. It's there in about less than 20 treaties. It's not present in the OECD model because, again, the OECD model is a traditional model. It was never there in the traditional OECD model because it focused upon there being a physical connection. In the case of employees of a foreign company coming to India and just rendering some services to an Indian client, to an Indian customer, but where doesn't matter. From which office doesn't matter. Which premises doesn't matter. They're just here in India and rendering some services. That alone will trigger a service PE in those treaties which talk about service PE, right? But again, generally speaking, most of these treaties prescribed a threshold, the number of days for which those employees should be present, like physically present in India to render these services. Then and then alone, this threshold will be considered to have been crossed. Then and then alone, a service PE will be triggered. Uh, Usually, you will find that this threshold is of 180 days, in some cases, more than that also. In some cases, for example, in India US treaty, the threshold is prescribed where the services are rendered to non-group companies, non-related parties, right? But when the services are prescribed are rendered to related parties, then there's no threshold at all, which leads to a lot of arguments that that means just one single days of presence in India for rendering services to a group company will trigger a service PE for a US company, right? I personally have my doubts. And even if that is the case, I will happily say that, okay, fine, for this one brief moment of time, I've grown extremely nationalistic, extremely patriot. I'll dump the treaty and I'll say I'm going for the act, and the act, the business connection still requires somewhat more permanence than just one day's presence. But those things aside, the concept of service P, as I mentioned, is a concept where the employees of a foreign company come to India, render services in India to a client, to a customer, and that alone triggers a permanent establishment because they have crossed a particular number of days in India, which is where a very important decision comes to comes up for discussion, and that's the one which Satish sir had also alluded to. This is a celebrated decision in the case of Morgan Stanley. It's a Supreme Court level decision. Here, the question was whether employees seconded or deputed, right, by a foreign company to an Indian counterpart and to an Indian group company will trigger some kind of a service PE in India or not. And here, the Honorable Supreme Court actually carried out a distinction between secondment and deputation, and then went on to conclude that where the people who are working in India are working under the control and management of the Indian company, the risk and reward of their activities is solely that of the Indian company. The foreign company, once it sends those people to the Indian company, it has washed off its hands from all the responsibilities. Nothing more to do, right? Then it would not trigger a PE because, frankly, in that case, it can hardly be said that the foreign company is rendering any services to the Indian company because it has just sent the people. After that, the Indian company is utilizing those people on its own. So no services are being rendered. A test which was added later on, thanks to a decision in the case of Centrica, was that of the test of lien, which said that all this is okay, but if these guys maintain a lien on their jobs with the company outside India, that alone is going to trigger a service PE, which is where, interestingly, the position stands as of now. But there's still a lot of scope of providing some value to your clients around service PE. At this stage, let's also talk about this digital PE thing, right? As I mentioned, this whole obsession about physical presence is the one which is probably going to lead to the downfall of permanent establishment as a concept. And it's not just me who's saying it. One of the most leading, tax uh, expert in the world. I'm talking to Mr. Philip Baker. He's KC, UK. So he's the King's Counsel in UK. Uh, he's actually authored an article sometime back which says that probably the whole concept of permanent establishment is becoming irrelevant, and we have to talk about some other kind of nexus, right? In 2012, when OECD started the conversation around base erosion and profit shifting, it also suggested that we need some alternative thresholds. Two thresholds which were discussed, although not recommended, in its action plan one. One of the several such concepts or replacements of the PE concept was significant economic presence, and India has adopted it in its own version. So it introduced it in 2018, but it was finally activated in 2022. The definition is there only in the domestic tax law. This concept so far, if you read it plain vanilla, is not there in the tax treaties, and therefore, in all probability, if your client has a TRC, a tax residency certificate, it can always sidestep the concept of significant economic presence by saying that it's there in the domestic tax law and we're aware of that, but it's not there in the treaty. The treaty still contains the good old concept of permanent establishment, not there of a significant economic presence. Therefore, even if arguably, I have an SEP, a significant economic presence under the domestic tax law of India, I still don't have a PE under the relevant tax treaty. Now, the reason why I'm highlighting this is because otherwise, the concept of SEP has moved away from this need for a physical presence. So long as there's a foreign enterprise which had entered into transactions worth crore or more in respect of any goods, services, or property, and that includes even software downloads and so on and so forth. And this is not just with any one single client or customer in India, but with all the clients and customer during the year put together. If that foreign company has sold goods or services for more than 2 crores, that will trigger an SCP. And you can understand that for a lot of businesses, this is literally peanuts, right? The second part of this conversation is even more dramatic, which is that where a foreign company has not even sold even a penny's worth of goods or services out here in India. It is probably making a lot of money elsewhere, yeah, but it has users in India and just 3 lakh users. That's it, right? Then that also will trigger an SEP, significant economic presence. So wherever you are dealing with any client, which is a foreign company, which has users here, or for example, if you're dealing with an Indian client that has made a payment to its foreign supplier in excess of 2 crores, then you have to be on a guard that will that trigger an SEP, and therefore, in order to guard yourself against your client against the need for deducting withholding tax TDS from such payment under the domestic tax law, you'll have to check whether or not that foreign corporation has furnished TRC to your Indian client. Okay, so we have talked about the season one is pretty much coming to a close now, right? We are talking about the reverse of PE. Right? those activities which do not trigger a PE, they are called PE exclusion. They're also called specific activity exemption. They're also called preparatory or auxiliary activity exemption, right? You sometimes also find the word preparatory and auxiliary. The word is effectively or, right? So I'll probably also use the word P and A, but let's not get into hair splitting for a guy who's anyway devoid of much hair, right? So Article 5.4 says that there are certain activities. If a foreign enterprise is carrying out these activities, no, sorry. If a foreign enterprise is carrying out only these activities, right? Only is important. If it is carrying out these activities, but other activities also, then there can be a PE resultant. But if the foreign enterprise is carrying out only and only these activities, nothing else, right? Then it will not trigger a permanent establishment of the foreign enterprise in India. What are these activities? A foreign enterprise carrying out only storage activities in India, or only displaying the goods in India, or only delivering the goods in India, or it is maintaining the stock for processing. And most importantly, and this one is also there in almost all the laws across the world, if the foreign enterprise is only purchasing locally that means India, for self, not even for group entities, for self, then all of these are economic activities, yes. And yet, none of these will trigger a PE in India. But the idea is all of these activities are fundamentally speaking either preparatory activities or auxiliary activities. Preparatory means in preparation to start the business. Auxiliary means, well, very sidey activities. Yes, I'm not saying that they're absolutely not contributing to the profit making capability, but that contribution is so infinitesimal that if we try to attribute some profits to that small activity, such infinitesimally small activity, then attribution will not lead to anything interesting as an outcome, which is the reason why let's not bother with treating these activities as PE triggering activities. Now, as you can already see, when this list was created at that time, yes, a lot of these activities were probably auxiliary activities, right? But today there are businesses which are successful, frankly, successful to the extent of being predatory, and only because of their being able to leverage on their capability to store goods and deliver them to you maybe in a day's time, maybe in 10 minutes time, right? And that is where the question arises that mere storage, mere delivery, is that any more an auxiliary activity? A lot of these companies were taking a position that we don't know, man. Sorry. Our alibi is, मैं नहीं कहता, तुम्हारी किताब कहती है, right? Your book, your treaty says that storage activity, delivery activity will not trigger a PE. That's what I'm doing. So what I'm doing at a huge scale, it still remains storage activity, delivery activity. Therefore, it will not trigger a PE for my US company in India. Yeah. A lot of countries world over started feeling the pinch, which is the first alibi that got broken down. And we'll talk about it in a little bit of time. Also, a lot of businesses started taking alibi number two. Alibi number two is fragmenting. Basically, what they started doing was they were carrying out an activity which was much broader, right? Which was not just a preparatory or auxiliary activity, which was a much broader activity. But what they started pretending was that they broke up this entire value chain into small activities. And these activities, right, multiple activities, they started carrying out at multiple places, not just at one place. Because if you carried out all those activities at one place, clearly that place becomes your fixed place of business, right? And more so, they were even more sophisticated in an advanced model of this, advanced structure of this tax avoidance. They would actually split up these activities into their various group companies, right? So company A1 will carry out the first part of that activity. Company A2 will carry out the second part of this activity. Company A3 will carry out the third part of this activity through their respective branches in India. But all of those branches are at different places: Delhi, Hyderabad, Mumbai, and three branches working on activity 1 by 3, 2 by 3, and 3 by 3. If you look at all three together, clearly it's a detailed activity. But what they are presenting as an alibi is the fragment of activity which is carried out at Delhi. That on a standalone basis is an auxiliary activity. The fragment of activity carried out in Calcutta by my group company, not even by me, right? That alone, that fragment alone is an auxiliary activity. Now, this advanced structure was also leading to a lot of headache. Now, this is getting serious, and we have introduced season two to you. We are now moving into the season two, where we'll talk about a new character being introduced. The new character, as I mentioned, was the Dhurandhar of the entire story, the Organization for Economic Cooperation and Development, right? OECD, it was observing from a distance for quite some time that a lot of such activities are being carried out by multinational groups and by respected names at that, right? Which is leading to artificial avoidance of PE status in source country. And it was granted a project by G20s to work on how to plug these loopholes, to come up with those action plans through which all those tax-based erosion and profit shifting exercises should stop. Action Plan 7 dealt with artificial avoidance of PE status. One of the most important things that it picked up was this abuse of preparatory and auxiliary activities exemption by fragmenting them, right? Because through fragmentation, you pretend each of these activities are auxiliary, but the reality is that they are not. And this is where they launched their secret weapon. The secret weapon being the MLI, through which these activities are now, this plug loophole is now plugged into most of the treaties. And mind you, India has happily incorporated this in the domestic tax law as well. So remember, I told you in the case of 1 day service fee in the US treaty, I will happily switch over to the domestic tax law. Can you do that here? That you can switch over to the domestic tax law and pretend that you don't have a business connection or a PE in India. If you fragment that activities, you can't. Because this provision is now there in most of the treaties, thanks to the MLI. And rest of the treaties will also adopt it sooner than later. And of course, they're in the domestic tax law. What does this provision say? So the season two begins with the first, launch of this MLI tool, and it says that if an enterprise or its related party, even is of enterprise, related parties E2, they are carrying out some activities in one place, place one, or maybe two places, place two also, or they can be place 3, 4, 5, 6, right? And they're carrying out activity one and activity two at these two respective places. Then you have to look at the overall activity when you combine all of them. Forget that they're located at different places, forget that they're being carried out by different enterprises, as long as those enterprises are closely related enterprise, basically group companies. Then combine all of these activities, look at them together. If all of them form a cohesive business operation, then you can't claim this exemption. Instead, this activity will trigger a PE for all the enterprises in question, all the group companies in question. Okay, construction PE. In construction PE, also similarly, a lot of international groups, foreign groups, were doing something similar. There, it is called splitting up of contract. Let me give you an example. Assume there's a metro project, right, which is of say 50 kilometers, right, and typically it takes about 12 months time to work on 12 kilometers stretch, right? So nobody wanted to cross 6 months, because the moment you cross 6 months, it triggers a permanent establishment, right? So this foreign group came forward and said that we'll take up this contract, but we will take it up in a specific manner. What is that specific manner? That my group company number one, company A1, will take up the contract for the first 5 kilometers, will take 5 months, will build it, and will go away. And then the next company will come into the picture, company A2, which will pick up the contract for the next 5 kilometers, will finish it in the next 5 months, and go away, and so on and so forth. That means 10 group companies, 5 kilometers each, 5 months each, finish the entire project of 50 kilometers in 10 tranches of 5 months each, 50 months. That means about 4 years. Good turnaround. And they'll finish the whole thing None of them will individually cross the 6 months threshold. And India does not have a concept of group company taxation, group level taxation. So no PE, no construction PE will be created, right? Not really. And that is where the second secret weapon is fired by MLI, that when we are dealing with these kinds of projects, then you will add up the connected activities which are carried out during different period by closely related enterprises. If they are all added, and if this crosses the threshold which is given in the treaty, then all of these companies will end up having a construction PE in India. Let's look at what the agency PE, creativity is going on. Those guys were also having some good alibis at their end. Yeah. I've already told you about the first alibi, the contract conclusion avoidance. Basically, I repeat, in this case, the agent would say that, hey, I'm not concluding the contract. I'm not signing it. Remember, the signing is being done by the principal. So he does not conclude the contract. He avoids it, right? He basically transferred the contract or encourages the prospective customer to directly connect digitally with the principal, and the principal will digitally sign the contract with the local customer. And therefore, they would argue that, hey, look, I have not signed the contract, therefore, I've not concluded the contract, I've not secured the order, I don't create the PE, right? But we already know the answer, we already know the fate to that, although this is also something which has been addressed through the MLI. But the second alibi, independent of this, imagine a scenario in which there's an agent company, right? And that agent company, an Indian company, is called upon by the tax officer, and tax officer says, "Hey, man, you're an agent. I hear that you're dealing with a lot of principals. Are you not?" It said, "Yeah, I'm dealing with a lot of principals, but I'm dealing with a lot of them, like really a lot of them. I have like 20 principals, and my total business from each of them is about 5% of my total business. So I'm hardly dependent on any." Yeah, and the officer had said, "Yeah, that means you're probably independent, right? So if you're independent, yeah, exactly. If you're independent, then you won't have an agency PE in India. Yes, exactly, sir. That's my argument." And in that case, the tax officer felt that, okay, fine. Probably this is one of those cases where there'll not be an agency PE. So he blessed the local agent that, fine, go forth and prosper. But just for the sake of completion of my documentation, why don't you please give me the list of all the agent? I'll just put it up in my file that, look, all of these are your principal, and against them mention what is a part of the revenue that you're earning. And it said confidently, no worries, sir, I'll do it. When it got the list, it found that the names of the principal are, imagine, I'm giving a hypothetical example, that the name of the principal are GE Power, GE Infra, GE Resources, GE Solar, GE this, GE that, GE up, and GE down. And all of these are a part of the same group, GE. And the officer suddenly said, "Hey, hold on. When I heard you say that you have 20 different principal and therefore you are independent, I thought these are unrelated parties." And the agent said, "So how does it matter? Because even if they are related parties, to me, they are separate principal. So I'm not dependent upon any one single entity, right?" And the tax officer said, "No, this is complete abuse. This is an alibi that you're using. Reality is you are a dependent agent. You're dependent upon one group, and that group is your GE group. So therefore, this should trigger taxing incidents. This should trigger an agency PE in India. And will this alibi work or not? There's a third alibi also. This is a slightly complicated alibi, right? So I'll not deep dive into it. But there's a model called a commissioner model. No, this is not a typo. There is actually an A in this definition. It's not commissioner model. It's commissioner model, in which interestingly, the agent does not enter into the contract in the name of the principal. He interestingly enters into the contract in his own name. No, it's not a bill to ship to. No, it's not a third port shipment. No, it's not that he buys and sells. It's slightly different, and it operates because of some certain kinds of agency laws. But fundamental thing is that an agency PE typically gets created, traditionally gets created, when the agent enters into a contract in the name of the principal. In a commissioner model, he doesn't. He enters into a contract in his own name and yet somehow successfully binds the principal, right? Through a complex legal part, which is not tax law, which is the agency and contract law, right? These are some of the alibis which were being used by agents to avoid creating an agency PE. What did MLI do about it? Look at the first highlighted part. Typically, in agency P gets created when agent concludes contract, but the MLI has used a different language now. It says where there's an agent and that agent plays a principal role leading to conclusion of contract. Mind you, these contracts are not concluded by the agent. In this case, the principal role is played by the agent, which leads to conclusion of contract, but does not say that the contract is also concluded by the agent. Right? They are routinely concluded without material modification by the foreign enterprise. That clearly shows that the agent has really all the power. The principal is just pretending to be sanctioning, right, to be approving, whereas actually it is approving pretty much everything which the agent is negotiating. Then you can't take a position that just because agent is not signing upon the dotted line, therefore it will not trigger an agency P. So this breaks down the alibi number one. The alibi number two, remember the dependence part of it. Here, the MLI draft said that as such, a dependent agent will not trigger a PE. This is what paragraph 1 in front of you on the screen says, right? That paragraph 1 shall not apply. That means an agency P will not be created. Where the person acting on behalf of the non-resident, that means the agent, carries on the business in the source state, India, as an independent agent. But there's an exception. But where this agent acts exclusively or almost exclusively on behalf of one or more enterprises to which it is closely related, then that person shall not be considered to be an independent agent, right? So, moment you're dealing with related parties, then this whole concept of this pretense of independence out of the window, right? Third alibi that I told you about was commissioner arrangement. Here in the MLI draft, I'm sure you can observe the difference between the first and the second bullet. In the first bullet, it is a precondition that this dependent agent has to either conclude contracts or play a principal role leading to the conclusion of contract. But these contracts are in the name of the foreign enterprise, right? That's the first bullet. And that is all that was the requirement in the original definition of agency P. But the MLI changed it and added another bullet. Here, in the second bullet, the requirement is not that the contract should be in the name of the foreign enterprise. It does not say it anywhere. All it says is that the requirement is for transfer of ownership of the property owned by the foreign enterprise, irrespective of whether the contract is in the name of the enterprise or that of the agent. It's silent about it. And the two bullets are connected by an or. So I repeat, if the agent is entering into the name, into a contract in the name of the principal, that anyway creates a PE. So that's covered in the first bullet. If the agent is super smart and it's basically in commissioner model, so the agent is not entering into the contract in the principal's name, then you can look at the second bullet, because the second bullet does not even want, does not even require, does not even stipulate the contract should be entered into the principal's name. All it requires is that the contract should be for the transfer of property owned by the principal, which is the case in a commissioner model. So that loophole also gets plugged. So we have covered the secret weapon for agency as well. And I have exactly 26 minutes left to go for Q&As as instructed to be by my moderator, Mr. Nikhil Agarwal. So Nikhil, over to you. Nikhil, you're muted.
Sir, can we take some questions?
Yes, absolutely. I'm looking forward to that.
Yeah.
Because those are the ones which I will pose to my clients and sound intelligent. I may not know the answer, by the way, but I'll try.
Sure. There are some questions. So one question is, directors are Indian resident and has appointed one local person as a full-time and fully authorized employee with complete powers of take decisions and operate bank account. What will be status of the company? Directors of Indian resident and have appointed a local person with complete power to take decisions and operate bank account. What will be the status of the company?
Good question. And I thank the person who has asked this question, because I was feeling slightly guilty that I probably don't have enough time to cover the concept of poem. which Satish sir had asked me to cover, right? So that this question gives me the opportunity to answer this question. So the question is that there's a foreign company which has Indian resident directors, and they have appointed a person who's also an Indian resident, and that person is the one who has all the powers to run the bank account, and I'm assuming everything else, right? Correct me if I'm wrong about my understanding of the question, Nikhil. Uh, See, two things here. Firstly, there is no crime if the directors are Indian. There's no crime that if a lot of day-to-day business decision making is being done by a person who's resident in India. Day-to-day business decision making, okay, right? Operating the bank account, I personally feel is day-to-day business decision making. Okay, that alone will not trigger a poem, a place of effective management of the foreign company in India, right? I personally feel this function alone might probably, in some cases, be said to trigger a small PE in India. Why? Because I assume this foreign company has no office in India, because otherwise we would have a branch office, and that alone would have become a PE. So this person who's operating the bank account is operating from home, and can a work from home setup also trigger a PE? The answer is actually yes. If it is one of the precondition for the employment, which is the case in this case because you don't have an office here, right? Then even a work from home situation can trigger a PE. There's a fantastic, commentary which has been released by HMRC, and there's a decision on this by the Danish court, right? I'm not getting into those. So at least at the minimum, there's a clear there's a clear risk of the fact there's a clear risk that there's a PE in India, maybe a fixed place PE in India, because of the presence of this employee in India who has all these powers to operate the bank account. Uh, Maybe he's operating work from home. Similarly, if the directors are also taking day-to-day decisions of the business, maybe it's a place of management, right? I'm not using the word place of effective management, mind you, I'm using the word place of management. In most of the treaties on Article 5, paragraph 2, you will find the place of management is covered in the definition of PE, right? I'm saying so because if the directors are present in India, I'm assuming that they'll be carrying out some management related decision making here. Whether or not a P will be created will depend upon a lot more other facts, and we can talk about them till the cows go home. But there's clearly a risk because of the presence of all these people in India. And mind you, if the foreign company is located in a country, the treaty with which has a service fee clause, then thankfully these people do not appear to be rendering any services to any client or customer in India. But if that's the case, then things will get even worse. But let's also talk about POEM, place of effective management. There's a difference between place of management and place of effective management, because there's a difference between day-to-day decision making and strategic decision making. Any decision making, day-to-day decision making is management, right? When I was working, sometime back in a company, 2008, if I recall correctly, I had the designation called manager because I was doing some day-to-day decision making. Right? Therefore, will that mean I'm taking the strategic decisions of the company? Absolutely not. Otherwise, that company would have collapsed by now, right? So, the strategic decision making is what triggers a place of effective management. Now, the gentleman who has been given the power to operate the bank account, maybe we can argue that making payments from the bank account is not a strategic decision as long as somebody has authorized the payment anyway, right? A lot of time in large companies, making of payment is something which somebody is doing in your accounts department, right? And he's authorized to make the payments, and therefore he operates the bank account, and that's it, right? So maybe it's not a strategic decision-making aspect. But in your example, in this query, the directors are also Indian tax residents. If they cannot demonstrate effectively that the decisions about the strategy, the way the business should operate, right, of this foreign company are being carried out outside of India. That means they get into a flight every 3-4 months and they fly to another country, maybe where this company is incorporated, the foreign company is incorporated, and they sit down around a table in that country, in some office in that country. And there, for the first time, they start scratching their head and they start thinking, hey, what should we do about this company's business, right? So if they are not able to prove that, then probably, it's a fair position to take that a lot of strategic decision making is happening in India. Secondly, remember the Indian version of poem also depends upon whether the foreign company has an active business outside India or not. Right? If it is an active business outside India, fine. Probably the threshold that that the revenue will have to cross to prove that we have a that this foreign company has a poem in India will be higher. But if it has no active business outside India, right, which is calculated as a percentage of the sales, payroll, and number of employees globally versus India, right? Then all the more reason that the de facto decision making, strategic decision making is probably located in India, in which case the poem of this foreign company is in India. You know what does that mean? It means that it's worse. If it had a PE in India, then only a part of its profits were taxable in India. If it is a poem in India, then for all practical purposes, it is a resident of India. And therefore, its global income is taxable in India, irrespective of that fact that the entire income is probably from clients which are located in country one, by employees which are sitting in country two, and from suppliers which are located in country three, none of which is India. Yet, all of that income will be taxable in India merely because of the residential status being that of an Indian tax residence, thanks to the poem concept. I hope I've answered that question to your satisfaction.
Next question.
Yes, please.
Having WS by MasterCard in India for that device in it itself seemed to having PE for that part of the business of device leasing, etc.
Those were not the facts of the case, because in that case, there was no leasing of the device happening actually, right? It's not that the US entity had leased the device to the Indian entity. It's not that the Indian entity had leased the device to the bank. None of the two. So I hear what you're saying. In fact, leasing, can it trigger to a PE? The answer is yes, depending on the facts, it may. Mere presence of device, can it lead to a PE? Well, there are some decisions, interesting one at that, where a vending machine has been held to have to be a PE, where in one very old decision, an advertising pillar is held to have a PE. And interestingly, when I told this fact to my team member, the two team members who worked on these slides, by the way, the name is Nilesh and Dimple. So if there's anything wrong with the slides, they are the ones to be blamed. They thought that it's probably I'm pulling a leg on, it's like a April Fool's Day Eve joke, but that's not right. That's a decision which is referred to in one of the leading commentaries, international commentaries. But to circle back, Nikhil, in the facts of MasterCard, this was neither argued that there is a leasing, nor were these a fact, I think, right? But it's an interesting observation, and it may have its P consequences and alternative set of facts. Yes.
My next question, sir, we have concept of POEM. Can you also cover this synergy between PE?
Yeah, I think this question may have been posted before I answered the first question. Is it?
Yes, sir.
Yeah. So I think I've sort of
This question is posted at the time of beginning.
I understand. But if the queries, if you want to reach out and understand more about it, my contact details were there at the end of the slides, or they'll be shared, I'm sure, in some form or fashion. You can reach out to me, and I'll be happy to answer this question. You can reach out through Cytex also.
Next question, sir. A US company wants to employ, say, 2-3 employees from India. The employees will work from India for US company.
Yes.
Is this allowed? Will it be considered as US company having P in India?
Yeah, good question. So I'm assuming that these employees sitting in India will be rendering services, right? But that's what typically employees do. Therefore, unless we can argue that their services, the nature of services that they are performing, are either preparatory or auxiliary, right? That means they're playing a very, very small, kind of role which hardly adds anything to the value chain. It's a very sidey activity, or maybe even a preparatory activity where they're trying to study the Indian market, feasibility about working, setting up a business in India. That's a preparatory activity. So unless that can be proved in a plain vanilla scenario, the question that you asked, Nikhilji, if a US company has onboarded a couple of people on the roles like employees, technically service P extends not just to employees, it also uses the word other personnel, right? So if you read the treaty, service P use the word employee or other personnel. So I think if they've even onboarded them as contractors, but full-time contractors, mutually, completely exclusively, can't work for anybody else whole time, right? They will also trigger a PE in India, because they'll be sitting here full time, right? As I mentioned, in this case, you don't even have to bother about the work from home concept because they are the employees of the foreign companies rendering services from within the country, and they're not going to be present here for 365 days unless, so therefore I don't see how they will avoid creating a PE in India. I am aware that there are a lot of instances in which creative structures exist for avoiding this kind of a PE status. But I think no structures are going to succeed unless your facts are clean, kosher, honest, right? So yes, you require good, robust agreements, but at the same time also honest facts to safeguard yourself. In this case, it's not that the mere presence of these employees will result in taxation of millions and millions of revenues in India. No. What is the profit attributable to the activity carried on by these employees in India is a simple question. If you were supposed to, hire a third-party service provider to render these services to you, what would that cost you? I think that would be the profit. So they will be taxable in India. Yes. So a P will be triggered in a plain vanilla facts mechanism.
Next question, sir.
Yes.
In case there is no provision of service P, what would happen to secondment of employee? Would this create P?
Yeah, it's a good question. It's a very good question. And again, in Morgan Stanley and a lot of other decisions, the revenue has repetitively argued that a secondment can create a PE even in a fixed place model. Why? Because let's understand, if they are employees of the foreign company and they are actually rendering services, right? First of all, I am past that argument of whether they are under the control and management of the Indian company or the foreign company. If assume the on this part, there is no doubt that some service is being provided. Right? That means they are not entirely under the control and management of the Indian company. They have a right to lien on their foreign job. The risk and reward, or some part of the risk and reward of their activities, is that of the US company, and so on and so forth. In that case, they are using the premises of the Indian group company, right, to whom they have been seconded. Those premises are at the disposal of such employees, and the disposal test has to be undertaken in light of the nature of disposal we require, right? This is also something which was very interestingly argued in a very recent celebrated decision in the case of Hayat, with similar facts, where the question was there where the overseas entities argue that look, we have sent some people to India, yes, but it's not that they're doing the business of the overseas entity, the UAE entity, right? Or they can use the premises for having their own meetings with other customers. No. So it cannot be said that the premises of the Indian hotel in that case are at their disposal. But the court held differently. The court held, hold on. You have sent these people for rendering certain services. That is the disposal that should be there with them. We don't want the disposal where they should be having meetings with other possible potential clients and customers. That's not the idea. These are not the guys who are supposed to be having meetings with other clients and customers. So if their function is to provide certain services to an Indian client, Indian customer, Indian related party, then the availability of premises, the disposal of those premises to these individuals to render those intended services, that is good enough disposal, Baba. And therefore that will trigger a fixed place PE. Even in the absence of service PE clause, a fixed place PE is still threat. I hope I've answered your question.
Thank you. Next question, Nilanskar. Sir, in case where an agent does provide service to group entities and he is able to show that through its clients are related parties, but these clients are deal in unrelated businesses or agency services provide.
Sorry. Can you start again? There was a bit of a glitch at my end, so I couldn't hear. Can you start again?
Yes, sir. Sir, in case where an agent does provide services to group entities and he is able to show that through these his client are related parties, but these clients are deal in unrelated businesses or agency services provided are not at all interrelated, then can we say that an department agency P is not created, or just the mere activity of provisions of service to group entities is enough to create a dependent agent PE?
It's a good question. I feel personally that same or similar business or related business This is not a precondition. I'll read the provisions again, of course. But from the way I recall, I don't think having same, similar, or related businesses, that is a precondition. What is the precondition is that your principal should be a related party. That alone triggers a dependence. So you can't anymore argue independence. But does that trigger a dependent agency PE? I'm not saying that. For PE, you still have to meet one of those three conditions of transaction. That is, either you have to conclude contract, or you have to deliver goods, or you have to secure orders. So, I repeat, if there is an agent which is claiming to be independent but is dealing with the related parties, then thanks to the amendments through the MLI, I'm assuming that the treaty that we are referring to is covered tax agreement covered by the MLI. In that case, it will be deemed to be a dependent, agent. Now, will the dependent agent also trigger a dependent agent PE? There, the answer will depend purely upon whether or not the dependent agent has habitually entered into one or more of these three activities, which trigger a PE for a dependent agent, which are concluding of contracts on behalf of the principal or in the name of the principal, or for supply of goods of the principal, or securing orders, or delivering goods. Any of these activities will trigger a PE. Yeah, that's where I start off this. It's a good question. I'll probably go back and read about this more, because
Next question.
right now I'm responding on the basis. Achha, there's
If
the next question. Yes.
if the partners of LLP in India are partners in LLC in UAE and they don't operate the bank account of that UAE company from India, but the partners are using their same email ID which they use in India, with trigger the POEM?
It's a very practical question. I hear you. I personally feel that that's my take on this thing. I'm not aware of any decision on the second part that I'm talking about, that using the same email ID is a crime. I don't think so, right? I mean, email is just a mode of communication. I understand that what basically we are talking about is that the two entities are similarly named, and they have probably similar sounding names, and therefore, when you are using the email ID, for the same email ID for Indian business as well as for the Dubai business, then that basically means that you both entities are same. I don't think so. I mean, they're only means of communication. There are good number of companies that we have come across where they use only one domain all across the world, and yet they have a very clear understanding that some part of the communications or some of the employees are working on a particular domain, some are on another domain. That's point number one. Point number two, however, more importantly, I think mere usage of email ID and mere operating of bank account, one way or another, whether you do or not, none of these two are strategic decision making functions which trigger POEM. So I repeat, a POEM is not triggered when somebody sitting in India is managing some part of the business or is carrying on some part of the business of the foreign company. No, sir. Right? That does not trigger a POEM. A POEM is triggered if and only if the strategic decision making of the foreign entity is happening in India. Strategic decision making is not equal to operating of bank accounts. So whether or not you operate the bank accounts from here, unless you are in a business in which operating a bank account is also a strategic decision, I don't think bank account operating. Personally, I never felt that that's a strategic, function. In a lot of offices, bank account is seldom operated by anybody senior, right? So that's point number one. And the second part, emails, depends upon what's written in the email. If what's being communicated in the email is decision making about a strategic aspect of the business of your Dubai company, then yes. And if at that time they were sitting in India when they were using that email ID, so the email ID is not a crime, right? If they were sitting in India when they were discussing about the strategic decision making aspect of the company located in UAE, then yes, that means the strategic decision making is happening in UAE. It can happen when you're sitting face to face. It can happen over phone. It can happen over a cup of coffee or any other beverage that you prefer, or it can happen over email. So use of a particular domain, that does not affect my decision making, process. I'm afraid the way I would look at it is that are the contents of the email related to strategic decision making or not? That's my take on it.
The next question. Sir, could you please throw some light on implications of trigger global judgment?
It's a good thing, but the moment I do that, I'll be stealing the thunder of the next speaker, the next webinar. And we had a fantastic, Tuesday morning session. So in our office, we have something called Tuesday morning training, TMT, right? Every Tuesday. So we had a fantastic session on Tiger Global in our office on that thing. So luckily, I even have the slides ready. So although that session was not taken by me, it was by another very fine, part of our team. But the moment I do that, Nikhil, the next people is 100% going to curse me. So let's not go down that route. If you want, however, I'll be happy to address that on a one-on-one basis, whenever you want.
Next question, sir. If the director of foreign company is resident in India, who also hold 90% of shareholding of foreign company, he attempts to business of the company when outside India, but the partners are using theirs, outside India, but he replied to the emails, etc., on day-to-day basis when in India, whether POEM is in India.
Again, it's the same question, I think, but in a different form. So first question, the fact that he holds 90% of capital of the foreign company. Oh my God. No, I don't think it matters. Even if he held 99.99% of the share capital and the other 0.1% is held by his father, doesn't matter, right? So shareholding doesn't matter. That's point number one. Point number two, he's responding to a lot of emails when he's sitting in India. I mean, who's to say that he's even the strategic decision maker, right? So if he's responding to a lot of email while sitting in India, I mean, good for him. He seems to be a busybody. But so long as it can be demonstrated that the strategic decision making is either done by somebody else sitting outside India or when he's traveling outside India, right? Then again, it's sufficient defense. But yes, the important part is you can't just take these positions, say these positions, and not prove them. Proving them will be actually extremely difficult because, practically speaking, when this gentleman, assuming he's the sole controller of the business, only director of the business, or one of the only active directors of the business, if he's taking 90% decisions, then probably the other 10% decisions he'll forget to be careful about. And then he'll habitually start doing them over the emails or otherwise when sitting in India. And that is what triggers a poem.
Next question, sir.
Yeah, sure.
What is the P exposure risk for US-based client managing and assigning tasks to Indian-based employee using an employer of record EUR in
It's a very
India?
good It's a very good question. And so the position is slightly, it depends upon the nature of contracts that you have entered into, the contracting structure that you used uh, in the EOR model. So because there are multiple EOR models, there's no one single answer I can give. But this is a bit of a gray area, quite frankly. So it will depend upon the nature of EOR contracts that you are using and the structure that you are using. I'm aware of at least 2 to 3 of those structures, and it will completely depend upon the structure that you're using. Essentially, let's understand this thing. What we call EOR in a day-to-day terminology is not necessarily the same thing. So again, a slight of caveat, but I will still say that this is a risky position. Typically, there are at least 4 parties in this entire exercise, where there is one ultimate employer, second individual located in India, and then 2 companies through which the entire structure is getting routed. But depending upon the nature of contract between ultimate employer, I'm using that word loosely, and the overseas entity and the Indian entity, and the Indian entity and the individual. As you can see, there are already 3 contracts that we're talking about. So, frankly, mathematically, there are 3 cross 2, 6 permutations and combinations, but I'm aware of 2 possible outcome, PE or no PE. एक और चीज practically, what we have seen is in at least 8 to 9 times out of 10, EOR model is used for something who's non-strategic, providing services which are almost auxiliary in nature. Because whenever you are onboarding somebody who's senior, right, somebody who's key to your business operations, then you would probably prefer a higher degree of risk hedging than to route the employment through an employer record model, right? Vice versa is also true. That person will also probably want, and I'm at a relatively key position. So he would prefer to be on the direct roles of a company rather than through an EOR model. So look at the commercial realities also, not just the permutations and combinations of legalities. Yeah.
Sir, next question.
Yes.
Has the POEM concept being diluted over the years, including holding of meeting in foreign branches from Indian residence directors?
Has it been diluted? No, I'm not aware of any such dilution. See, I understand if you are saying that now we are living in an age where we can have VC meetings, right? Through Zoom, through Teams, and so on and so forth. I understand, yes, you can have that. And frankly, that was true even before the poem concept was introduced, which is the reason why companies have introduced some, guidelines on VC, board meetings and so on and so forth. All said and done. I don't think that means that there's a dilution of poem concept. Indian guidelines on poem are anyway even more advanced. Quite frankly, they are not the same as the global interpretation or the usual interpretation of poem because we differentiate between companies having active business outside India (ABY) and those who don't have it. So, in a roundabout manner, uh, we have a bit of a CFC norms introduced into our poem regulations, right? But having said all that, uh, when the poem regulations were not even introduced at that point of time, I am aware that there were clients who were holding business meetings, board meetings also over Skype. And then when this provision was introduced, we have probably migrated to some fancier tools, and now we have migrated to even more fancy tools. Uh, is there a need to? I don't know. Maybe yes. Personally, I feel so. Has that dilution already happened? I don't think so. I've not witnessed that argument succeeding before any authority that come on, now everybody's having meetings on Teams. What's wrong if I had a meeting on Teams sitting in India and took some strategic decision? That doesn't mean that the foreign entity has poem in India. Yeah. I don't think that outburst will prove a lot.
Next question, sir. In group companies, what are the important points which need to be checked to establish if the foreign company has PE in India because of the transition with the Indian group companies?
In group companies, what would be the important points to sort of consider to decide whether or not the foreign entity has a P in India because of this transaction? That's the question, right?
Yes, sir.
Uh, so see, mostly my answer will depend a lot upon whether or not the transaction is with the group company, except as I mentioned, when the agency fee gets triggered because the agent is deemingly dependent because of this closely related enterprise, or when the service fee threshold comes down in some treaties because the service is rendered to a group company. But otherwise, look at the basic nature of transaction. So I'll I'll give it the answer in four ways. Uh, if the overseas entity is rendering services to the group company through employees, service fee risk, yes, clearly. Secondment and deputation we have already talked about, which is a subset of that. Right. Second, if the overseas entity is using the Indian entity as a marketing support service provider, and there it crosses the agency fee threshold, that's a second risk. Third, if you're using the Indian subsidiary, basically as a virtual extension of the foreign entity. So Indian subsidiary is not carrying out the business which is completely independent, but actually, in a sense, it is helping foreign company do its business, right? This is a bit of a gray line, mind you, because virtual projection concept is always going to be a gray line. Then that's a third risk. And the fourth risk is where the offices of the Indian entity are at the disposal of the overseas entity. There can be other scenarios also, right? There can be other scenarios also, but these are the primary, four kind of things that immediately come to the forefront of my mind. In a construction business, we have already talked about how you can try fragmenting the activity between your group companies in preparatory and auxiliary activity exemption or specific activity exemption. Similarly, we have talked about how you can try splitting up the activity using your group entities. So if you fall under any of these, that's how a transaction with a group company will trigger a P.
Right, next question. A private limited company registered in India and directors are also registered in India. Company has subsidiary in UAE. The entire group business is managed by CEO who is resident of UAE, who has the bank control of India and as well as UAE. Whether UAE entity is said to have PE in India, a small classification that digital signature or important documents were signed by the directors of India.
why would the poem be in India when the director is sitting in UAE? I think the question should have been other way around. Can the Indian company have a poem in UAE? Because interestingly, the UAE corporate tax law, the federal decree law, right? It also has a concept of poem, and their concept of poem is slightly more global than the Indian concept of poem. So it does not even differentiate whether or not the Indian entity has an active business, outside UAE or not. Circling back, I think the question should have been, unless I'm misunderstanding the whole point, the Indian entity has a director who's not located in India but in UAE, right? And the UAE company has the same person as a director who's anyway located in UAE. So if the UAE company has a director which is located in UAE, assuming there are no additional facts, there's no trigger for an Indian poem. The fact that there's an Indian group company also there will not trigger a poem, right? So decision making is ever never done by the Indian group company. So uh, unless I'm mistaken, that's my answer. Shareholders, that doesn't matter, as I've already answered. So if the decision making director, let's call him the big boss, right? If the big boss is sitting in UAE and the company is also located in UAE, then you are doing the right thing. Then the question is that the big boss of the Indian company is located in UAE. So do you have poem in UAE? In which case, the problem is you have already missed the deadline to file your first corporate tax return. In fact, the next deadline is around the corner. So you should have fast.
Next question, sir.
Yeah.
AFPI hiring a manager in India to provide
Sorry.
AFPI hiring a
FPI.
manager
Yeah.
in India to provide the fund management services. Will there
Hmm.
be a question about the FPI being considered a residence and having a P in India?
Unless you qualify for the exemption, which is expressly built into the Act, I think it was Section 9A in the old law. I mean, because it's 1st of April, right? So the old law is now old law. So unless you qualify for the fund manager's exemption, which is by the way not very unique to India. A lot of other countries have it. Hong Kong is right now, as we speak, pretty actively working on that thing and is going to come up with the next level of fund manager exemption and whatnot. But unless you qualify for a fund manager exemption, in which case obviously there'll be no business connection in the domestic tax law, so we don't have to worry about the PE anyway. But if you don't qualify for that, then my question will be why not? Because a fund manager is a soul of an FPI. So I would definitely say that there is a PE risk. In fact, we'll have to worry about whether there's a poem risk also.
So next question. Whether the large MNCs based in USA allowed the Indian citizens to work in India for 2-3 weeks. Create PE.
Good question. Personally, I think for 2-3 weeks, if people are working in India, and assuming I'm not talking about the services rendered to group companies, that's not the case, right? I mean, basically, there's a US company and it has some employees, and those employees suddenly realize that they want to discover themselves, or they want to learn yoga, right? Or they want to attend discount, whatever, and they have decided that they'll not take leave because the company is a very employee friendly company. So they decide, hey, we'll travel to India and we'll attend our yoga lessons and we'll discover ourselves, whichever way one is supposed to discover oneself. And they work from India for 3 weeks. Well, hell, by 3 weeks they work for 2 months. Doesn't matter because that doesn't trigger a service. That doesn't cross the service P threshold anyway, right?
The next
So I don't think
question.
a P is getting credit.
What is difference between tax treaty and MLI? Does MLI override the tax treaty?
Okay, it's a good question. It's $1 million question. So tax treaty is a bilateral agreement, right? Two countries, they decided that we don't have to let our businesses, I mean, our two countries, our businesses suffer from double taxation. So they enter into a double taxation avoidance agreement, what we generally call a tax treaty, generally, right? It is also called, to be more technical, it is called Convention for Avoidance of Double Taxation, CADT. MLI is a very unique kind of a tax treaty, right? It's not a bilateral tax treaty. A lot of countries came together and signed it. Therefore, it's a multilateral instrument, MLI, right? There's a different purpose of the MLI. The purpose of double taxation avoidance is what's written in, for instance, from our perspective, from India perspective, it is written in Section 90. Right? There should be relief. There should not be any double taxation. There should be exchange of information. People should not steal, taxes. Blah blah blah. Those things. Multilateral instrument has a very specific purpose. which stems from Action Plan 15 of Waste Erosion and Profit Shifting 1.2, Project 1.2, which is a lot of things which were agreed by the OECD inclusive framework. That means OECD members, a lot of non-members also, which worked on this project, right? They all came together and they agreed upon a lot of things. Some of those things, not all of those things, some of those things, which are to be incorporated into the treaty. Rather than asking the members to renegotiate the respective treaties separately, right? Through separate bilateral renegotiation, which will take their own time. And then every treaty, every bilaterally renegotiated treaty will come out differently with one word change here, one word change there, and that arbitrage will create the next round of tax avoidance strategies. Instead of all of that, it was decided, hey, let's come together. The inclusive framework comes together. All these 130 plus countries come together. We create a common treaty. Everybody who's on board with it, they sign it, they ratify it, and therefore they will agree that the MLI applies to their treaty. So to that extent, MLI is to be read with their treaty, which is the reason why the old treaty will now will now be called the covered tax agreement, right? Covered by the MLI. It will be called the CTA. So in a very loose sense of fashion, maybe we can say that MLI overrules the tax treaty, but that's actually not the way it is. MLI amends the tax treaty. So does the Finance Act overrule the Income Tax Act? No. Finance Act amends the Income Tax. So similarly, there is no reason for MLI to overrule the tax treaty because the purpose of the MLI is to amend the tax treaty, right? So therefore, my answer to your question, sir, is the MLI is to be read with the tax treaty. I hope that answers your question.
Next question, sir. If people are sitting in India and making decisions in meeting based on the entity located outside country, will it trigger POEM?
So
I think
okay, I'll be happy to answer this question, but it's already 18:02. It's 2 minutes past the deadline. So I'll have to first seek the permission of Kapil sir, right? That do we
Sir,
go
I
ahead?
have two more question on
Last question, sir. No
I
issue.
have all the time. I have
Last
all the
question,
time.
sir.
last question.
The last question. Yeah, this is last question.
Okay. सो निखिल एक काम करते हैं, ये वाला क्वेश्चन ना हम आंसर कर चुके हैं, मैं बस एक लाइन के अंदर बताता हूँ, तो अगला क्वेश्चन को लास्ट क्वेश्चन कर देंगे, तो ये तो छोटा सा क्वेश्चन रहेगा ना।
Yes, sir. Yes, sir.
तो ये है कि देखिए सारे डिसीजन नहीं, स्ट्रैटेजिक डिसीजन
question.
अगर पोएम नॉन स्ट्रैटेजिक डिसीजन डोंट। अब वाला
Sir,
क्वेश्चन लास्ट
Next question also is same. If the decisions are conveyed through emails when in
आगे चलते
India,
हैं, हो गया है। आप ईमेल से टेलीपैथिकली कबूतर के पैर पे बांध के मेघदूत के अंदर, जैसे हमने कहा था कि मेरी आशिक को कहा था कि भाई जाके क्लाउड्स मेरा सारा, किसी भी तरीके से आप अपना डिसीजन कर, मेरा मतलब ना क्लाउड कंप्यूटिंग की बात कर रहा हूँ मैं, आप कैसे भी करिए, राइट, आई डोंट केयर।
one more.
स्ट्रैटेजिक डिसीजन
HPE operate outside DTAA?
in the Indian context, not really, because in the Indian context, the concept is business connection that operates outside treaty. EE is defined in the treaty, but in the act, but for a different purpose, which is basically, for TP, transfer pricing. But I don't know it sounds like a bit of a philosophical question, but I'm giving a literal answer. PE operates within the treaty framework, not outside.
Thank you,
Right?
sir. Thanks a lot
Thank you so
for your
much. Thanks,
wonderful
thanks.
deliberation. You explained in a simple way and very important topic. Thanks to all participants for your cooperation. Thank you. Thank you so much, sir.
Thank you. Thank you. Entirely my pleasure. Thanks a lot. Thank you,
sir.
everybody. Sitax, thanks a lot. Nikhil ji, आपने बहुत
Thank you,
अच्छे तरीके
Nikhil
से connect किया.
sir. Thank you, Gaurav
Thank
sir.
you. Thank you, Kapil ji.
Thank you.
Always a pleasure. Thank you.
Thank you so much.
Thank you, sir. Thank you.
Asfaq. Yeah.